Hey guys, Wes Nakamura from Real Vision in Tokyo. Just want to make a couple of quick comments on the yen, as well as how it relates to the U.S. Treasury market and a trade that I have on going into CPI and other macro data as well from the U.S. But starting at 8:30 on Wednesday morning, which is to be long U.S. Treasuries via calls. So let me just run through a couple of quick charts. Red line, USD JPY, dollar yen, which recently just broke out into the 113 handle, putting it at a 2018 level. The yen is the worst performing major FX pair against the dollar year to date. It's like a minus 11% on the year. And it mirrors the chart of the 10-year U.S. Treasury yield. This is basically a reflection of, Japan flows, which are significant for U.S. assets, namely treasuries and U.S. equities. Japanese institutions, corporates, individuals, investors, they're sitting on tens of trillions in cash, collecting zero yield on JGBs thanks to Bank of Japan's yield curve control, which pins the 10-year JGB yield around zero. I've said this many times before, but Bank of Japan's yield curve control is indirect U.S. yield curve control, because when Japan domestic yields are capped at zero, okay, Japanese investors buy U.S. treasuries, which then caps U.S. treasury yields. They don't care what the actual yield really is because it's better than zero. And they definitely don't care about this so-called U.S. credit default risk from, nonsense debt ceiling theater, because Japan's debt to GDP is the worst in the world. It's 250% debt to GDP. So treasuries are always safer and always yield more than JGBs. And so therefore there's always a major buyer in the form of Japan or Japanese investors. Hence, Japan being the largest foreign creditor to the US. Okay, this is a chart of SPY, the S&P 500 ETF in green, compared with the same S&P ETF listed in Japan. The Japan one is the white line, okay? Both of these are S&P 500 ETFs, the same makeup, but the Japan listed one is outperforming SPY by more than 10% year to date, and massively outperforming the Nikkei. Japan has been buying the S&P 500 and contributing to its upside. It has for quite some time now, and for quite some time now, it's been a fantastic trade. They're getting much more of a return than U.S. investors are on their own index. You need to keep this in mind, okay? The S&P 500 is not a U.S. asset. It is a global asset with global investors and global flows. And just because it has a pullback to some, 200-day moving average or whatever it is, it's not always a 200-day moving average for everybody. Some S&P investors are up 23%, 24% on the year, rather than 13% for U.S. And therefore, they have a lot more downside to tolerate, they have a lot more volatility to tolerate, they have a lot more gains that they're sitting on. Okay, bonds. This is a chart of IEF in blue, which is the iShares 10-year U.S. Treasury ETF. In red is the same exact iShares 10-year U.S. Treasury ETF, but listed in Japan, and it's FX hedged. In other words, it negates any FX impact, and thus it performs basically exactly the same as normal USD investor of US Treasuries. Year to date, owning one of these, 10-year US Treasury has been a losing trade as yields have, shot up from under 1% to well over 1%. However, this does not mean that all US Treasury investors are losing money. The green line is also the same 10-year US Treasury ETF listed in Japan, but no FX hedging. Okay, so if you had bought U.S. Treasuries from Japan without hedging the yen, okay, not only would you have never taken a loss this entire year, but you're up 5% in absolute terms and up nearly 10% in relative terms against those who hedge the yen or against just a standard U.S. Treasury buyer, USD Treasury buyer, right? And so what can we attribute that to? Well, obviously it's the currency, it's the yen, right? The yen is doing all the heavy lifting, and it is making night and day differences in return profiles between ETFs that are holding the exact same assets, 10-year U.S. Treasuries. So for the Japan investor who went long S&P and long U.S. Treasuries at the start of the year, you've yet to take a loss for this year, and you're actually doing spectacularly well, right? Just the equity portion alone, just being long SPX, in like yen terms, you are essentially outperforming every major index in their domestic currency. Okay, so the question is, why is the yen getting slammed as of late? Who the hell knows? Okay, part of it though is hedge funds. So the red is yen futures on CME, and the green is 10-year U.S. Treasury futures also on CME. Hedge funds have been very crowded net short yen futures on CME. They're playing the policy divergence of, continued easing by the BOJ versus tightening by the Fed. And this also coincides with shorting CME 10-year U.S. Treasury futures. And that's why these two are moving together in tandem. Now, on Friday, U.S. non-farm payrolls came in far weaker than expectations, but the market seemed to shrug it off. People were saying that this is due to, the bond market still convinced that the Fed tapering is still going to happen regardless and all that. And maybe so. But this is also due to a continued active shorting of yen futures we're getting very close to a very key put options strike with a huge open interest at 90 on CME yen futures. And as the yen pushed down towards that in-the-money level, treasuries did as well. And that's why 10-year yields closed at their highs at 1.6 on Friday. And then on Monday, when global markets were open, but due to Columbus Day in the U.S., the U.S. Treasury market was closed, like by itself. And that basically left the yen in control and unanchored to U.S. Treasuries. And then you can see this rip in dollar yen from right around 112 well into the 113 handle. And then you combine that with the yen put options open interest positioning that I just mentioned before at 90. That was breached. That triggered a gamma flip from 90 downwards, and then you get a sharp fall in the yen, a sharp rise in dollar yen, and a sharp rise in implied U.S. Treasury yields for when the market would reopen. But when treasuries did come back online on Tuesday, you saw both yen and 10-year U.S. futures bottom, and then you had a non-disaster of a 10-year U.S. Treasury auction go off, relatively smoothly. And then you start seeing a reversal in yields. So during this time right here, I went long calls on ZN, so 10-year U.S. Treasury futures. So going into CPI 830, kind of a very interesting setup because, look, I don't know what the number is going to be, and I don't care what the number is going to be. I care about the market reaction, and that's it. So it seems to be that with yields at still kind of near their all-time, or not all-time highs, their year-to-date highs, although pulling back now, but nonetheless, it's still pretty high up there. You could assume that the Treasury market at the long end is pricing in some sort of non-transitory inflation reading. Probably at the headline level due to energy and oil, but nonetheless, probably not expecting it's not a coin toss for a miss to the downside. But CPI has been slowing, and core CPI has been slowing. Rate of change wise, it is not out of the question at all to get a slowdown in CPI. Market seems to not be braced for that at all. So if CPI comes in strong, it looks priced in. So big deal. However, if CPI misses to the downside, in other words, if CPI comes in weak, then not only are you going to potentially get a pretty swift market reaction from that, because that's not really being priced in. It's kind of being priced in as we speak right now, but not really. But you're also going to have Friday's shitty non-farm payrolls data that was a horrendous miss, but the markets brushed off as like, oh, well, the Fed's going to taper anyway, just carry on. That is now going to come back into the picture, and you're going to get both of those things priced in potentially. And then in addition to that, if you have a continued terrible reading on the U of M consumer sentiment survey at the end of the week, all these things in combination could lead to a reversal in the uptrend in yields and in U.S. Treasury yields. So the way that I'm trading this is I'm long calls on 10-year U.S. Treasury futures. However, I'm not in it for this move. I'm in it for a convex move. and potentially we can get one at 8:30 or 8:31 a.m. With the CPI reading. So asymmetric, risk reward. I don't know what the actual market reaction is going to be to what the data is going to be, obviously, but it seemed to make sense, and I could always rely on the Japanese institutional flows that will come in around these levels to get long U.S. Treasuries. So that's how I'm trading it. That's the significance of dollar yen through 113, and why you should be watching it. Why you should be watching it in tandem with 10-year U.S. Treasuries. And by the way, the reason I'm not like buying, calls on like TLT, for example, or IEF, is because I'm potentially going to be out of this thing at like 8:32 before at cash equity open, which is when TLT and all that trades. Anyway, if you enjoy this, and if there's a huge move in the markets, I will probably do a follow-up, so keep a lookout for that. But otherwise, I will be making market commentary on global cross-asset markets, any sort of interesting catalysts or price action or things that might have been missed or overlooked, you will hear me talk about. So hope you enjoyed. Keep a lookout for more, and we'll see you soon. Thanks.